Good morning, good afternoon, good evening, folks. It is Sunday, and that means we bring back a very good friend of the channel, someone I've known for multiple decades, Mr. Dan Bird. How you doing, buddy?
I'm doing well, but that makes me sound old.
Well, it makes us sound old. So
we met in kindergarten, right?
Yeah, exactly. We were neighbors. We shared a picket fence. There you go. Right. Hey, something I thought we should do is we should talk about the market. Just kind of where are we now? I think we got to talk about the Fed getting ultra hawkish last week. There was definitely a game changer from my perspective.
But were they really?
Well, we're going to talk about it. We'll set it up first,
right,
and we'll talk about each of these. Then we'll talk about CPI. And then number 4, kind of part of this, we'll talk about what if we're not in a secular bull market. So let's go back to topic number 1, just basically what's going on in the market.
All right, let me show you a quick chart.
I need to give you
that I've shown. Oh, yeah,
I just did.
Access. Okay. That we've looked at many times before. This is the S&P.
Yep.
These shaded areas are the average true range.
Yep.
So it's just starting with the darkest one in the middle. That's the average range. It typically moves in one day. And then the second one is 2 times the average daily move. And the third one is 3 times the average daily move. And it usually, if it gets up to 3 or down to 3, it doesn't stay there very long. It'll come back to the mean.
Right.
All right. The mean is the 21-day moving average, which is this dotted blue line. And you can see that that's where we are.
Yeah, look at that.
Right now. So we had a really nice rally, 2.5-week rally.
Yep.
Right off the lows down here, way up here into 3x ATR. And now we've come back to the mean. So what's next? Where is it headed next?
That's a great question. Obviously, we have really earnings season starts next week, usually with the banks.
Yeah.
I think I wrote them down this morning. I don't know. All the big banks report next week. Goldman Sachs, Morgan Stanley, Citigroup, BlackRock, a lot of these guys. So we're going to find out. I think they start Tuesday, I think.
Right. And I suspect that Q1 earnings actually won't be too bad.
Okay.
But I think the projection for the rest of the year they might be pulling in their forecasts.
Yeah, it's actually something I talked about on the daily financial news this morning is, I think, earnings are always looking backwards. They're going to be okay. I wonder if their announcements is going to talk about loan deterioration. Because again, banks, generally speaking, we talked about this like 6 weeks ago or 8 weeks ago, in a rising rate environment, banks usually do quite well. But what we've unfortunately had is we've had rising rates accelerate like no other time except the Paul Volcker era. And I think what the banks might be reporting, not all of them, but some of them, is loan destruction, like loan demand falling off a cliff, which will hurt earnings. And I might even call, it probably won't be this quarter. It might probably be Q2 earnings. We may have a couple of banks talk about layoffs.
So let me understand your thesis for a second.
Sure.
Let me just try to put it into ordinary language.
Sure.
Banks have been lending because rates have been so low.
Correct.
So they've been doing lots of loans.
Correct.
But they haven't really been making a lot of money on those loans.
Yeah, they made it up in volume, as you would say.
That's right. So theoretically, if the rates are going up, you would think, well, now the banks can make more money. However, all the people that wanted loans already have their loans.
Yes.
And they have them at very low rates
that
the banks will have to honor.
Yeah, the 30.
So even though rates are going up and theoretically banks should make more money on new loans, there are fewer and fewer people making new loans.
Absolutely. There's no question. I believe the refi demand, which a lot of these banks have been profiting from, is going to crash upwards of 75%, already down 60. I believe the greatest destruction that nobody's talking about yet, because rates went up so fast in a 10-week, now 11-week period, that new loan demand, purchase demand, is going to fall off a cliff. Because again, there will be people like yourself who just closed on a transaction because you had to, right? It was a family decision.
Yeah, and by the way, that was 5 weeks ago now, when rates were still reasonably low. I mean, you were in the standard,
fours, right?
The standard rate right now is 5.75 5.08 last one I saw.
Yeah, 5.02, 5.08. Yeah, over 5.
And that's for a owner occupied
Correct.
mortgage, right? Mine was an investor mortgage, which is always higher.
Correct.
And I got mine at 4 3/4. I feel great about that now.
You do, exactly. Now, what I believe is going to happen is we're going to have a 3 to 5 year period where supply is destroyed. Yeah. Move up buyers who got in the last couple of years, lots of equity, they're not going to move. They're not going to go out. So I again believe there will be banks. I think it's a little early in Q1, but I believe by Q2 we have banks talking about layoffs because of loan demand.
Well, mortgage companies a month ago, 6 months ago, were trying to hire anybody with a pulse.
Correct.
Just to process mortgages.
Correct.
They are already talking about layoffs.
No, yeah. Again, mortgage industry is already cutting. Better.com is one example, thousands of people. I'm talking about the big banks, the Wells Fargo's, the Bank of America's,
right.
JP Morgan Chase, all those folks. I believe you're going to see layoffs because this is what happens when you raise rates, and it rose so fast that we have both demand and supply destruction. That's
and the rate acceleration has only just begun.
Exactly where we're going to go to here in topic number 2. Did the Fed really get hawkish last week? Is there a game changer?
Yeah, did they really?
So here's the deal. This is a critical conversation for people betting on the walls who are betting on stocks. There's basically.
And by the way, while you're talking about that, I'm going to put up my. If anybody wants to get my newsletter, is Breakpoint Trading. Just send me a note, breakpointtrading@gmail.com.
Yep.
I'll be happy to add you to my free newsletter that I send out every week. Mm-hmm. But if you notice the cartoon up here on the right, that's the topic we're talking about.
Yeah, is the Fed. So here's the deal. I've been studying the Fed for 30 years. And what I've come to realize is once you figure out the president, you can basically see what's coming. Now, obviously you could be wrong, but that's what I'm betting on. So for example, Paul Volcker was easy. He was in charge. He was going to damn the torpedoes. Didn't matter. He raised rates on the weekends. He didn't give a rat's ass about Wall Street. Mm-hmm. Okay? That was Paul Volcker. Greenspan was the ultimate. He made Fed speak. He basically was so convoluted that if you understood him, you didn't understand him. Bernanke, he was the tried and true quarter point every time, no matter what, right? He never thought any different. Now we have Powell. I was hoping was going to be more Paul Volcker and go a 0.5 point last time. I called it. We've talked about it. It didn't happen. It turns out in the Fed meeting minutes, he wanted to do a 0.5, but we had this unfortunate event in Europe. So he acquiesced and went with a 1/4. If you were to ask him today with true term, he would have told you that a 0.5 was the right answer last time. So who is Jerome Powell? Jerome Powell is proven to be more like Bernanke. Basically tell the market what's coming over and over and over again, and then deliver. I actually
think he is a hybrid of Volcker and Bernanke.
Oh, if that's the case, then yeah, you bet your ass he's going to be hawkish. So what I tracked.
Well, he's a hybrid. He's going to be hawkish, but he's not going to be too hawkish.
Correct. I see.
And he won't be too dovish either. Oh, so no, in the lower left corner here, this was in my newsletter also. Mm-hmm. This is the market expectation for Fed hikes.
Yep.
Right.
Yep.
So you can see, going out to December, the end of the year, 75% chance of 2.5 to 2 3/4.
Did you hear what James Bullard said yesterday?
No. James
Bullard wants it at 3.5 by the end of December.
3.5. So that's way over here on the right-hand column.
That is 5 50 basis points move and 175 basis.
Yeah. So if we apply this to the market, because that's kind of our topic.
Yeah.
The market thinks there's a 0% chance of that happening.
Correct.
That's going to have a huge impact on the market.
Correct. If it happened, because they're not expecting it. Correct.
Yeah. I don't think it's going to happen.
No, I don't. I'm not saying it's going to happen. I'm saying we have one of the Fed. Basically, where I was going to go last week, I thought was game changing, because going into last week, the Fed team was roughly 50-50 split, Dove and Hawk, roughly. It was actually, it leaned hawkish, but you could still go 50-50 basically. What happened on Tuesday and Wednesday is every Fed president came out as a hawk, including the biggest Dove, Brainerd.
Yeah.
And
but they came out as hawks in their speeches.
Correct. What else can they do?
That was not necessarily reflected in the minutes, because the minutes were from a month ago.
Correct. No, I'm not saying that. Basically, what happened on Tuesday is the Federal Reserve people came out the day before the meeting minutes and basically said, pay attention. We are going up and we're going to go up faster than you expect. Then the meeting minutes came out that basically said 25 basis point was a mistake. And they need to and oh, by the way, they are behind. Every Fed president has said they are behind. So we are getting a 50 basis point raise in May. Is that what this says?
Yeah. This says
100%. Yep.
Yeah.
May
4th. May 4th.
We're going to 75.
100%. We're going to 1.25.
That's by June. That's by June.
81%.
Yes, by May.
By May, yeah.
Okay. So again, very likely.
That's right.
I think we're going another 50 in June, which would take us to 1.25.
Right.
Okay.
And that's what this says.
And oh, by the way, I called that 2 weeks ago, and I'm glad I have all my videos to prove that. Now it gets interesting. After we get to 1.25 by June, what happens? That's where I think we're going to start to see doves and hawks again. And a lot of that's going to be based on inflation prints. And you and I know we get a CPI number on Tuesday, which is two things. One is I think it's going to be in the 8s. And the second thing is I think it might be the high water mark, which is interesting.
So here's my chart. Here's my chart that I've been tracking for a few months now.
Yeah.
I update it after each meeting,
yep.
each CPI. This will get updated next week. So February 7.9.
Yep.
Fannie Mae is projecting 6.6 by the end of the year for the whole year.
Correct.
I am projecting 9.
Yeah.
On this next one on Tuesday.
It could be bad, or I should say, it will be bad.
But even with that, even if it is 9 or even 8.6 or whatever it is, and I'll adjust all of these with the real number. Everything in light red is estimated. Even if it is, you can still see peak inflation is here in March.
Yeah.
March.
Yep. Yep.
Right. So you're right. By June, now peak inflation may be in March, but you won't know that.
No, you won't know that for
until
months.
You won't know that. So this is the April. March is the April report. Right.
Yep.
The May report, which is coming up.
Yep.
We're not going to know where peak inflation is until at least 2 months later.
Correct. Absolutely.
Because one data point doesn't make a trend. So
correct.
It's at least 2 months. So we're looking at June, July before you even tell that there's there was peak inflation.
No,
but just like you said, that's when we'll start getting doves and hawks again.
Yeah, and really, what people need to realize when you hear me talk about or you read about base effect, Dan has highlighted it for you here. Notice at the very top of this chart, March 21, 2.6, then April 21, 4.2. Each of these rolls off as another month is done. That is the base effect rolling off. Basically, inflation still could be bad, but you're doing bad on a bigger number. Just how math works.
Yeah, if the one on the left is what it looks like right now. And this is the one that the Fed is using to raise rates.
Correct.
Now, I think the Fed knows that it's going to look like this.
Yeah.
Later in the year. I think they already know that.
Well, let's just say this, they're betting on it.
Yeah, they're betting on it.
Absolutely.
But they can point to this one here as cover.
Correct.
To raise a half a percent. And I agree with you. I think they'll do a 0.5% the next 2 meetings.
They have to. They just
because they can. If they get too far out, the curve is going to start to be going down. Then they're going to get questioned of why they're doing half. So they might as well do the half now.
Yeah, they got to do half early. So again, I think rates are going up a full 100 basis points or a full point at the front end of the curve. I believe the bond market, Dan, has priced this in. You have seen the 10-year race. Right. You have seen a yield inversion uninvert, right? It's something else that has happened, right? It was inverted for like 3 days or 2 days or something.
Yeah, if even maybe one day.
Yeah. So the other thing that's going to happen is the Fed's going to start dumping. So the first time in my adult life, the Fed is going to be able to control the front end and the back end because they have all the treasuries and mortgage.
Yeah, so that's a good point. I mean, that's why I asked the question, were they really hawkish? And they while they did say they were going to stop buying,
they've already
they did not say they're going to start selling.
They've now, so the step one was a framework, because as I've shared in my daily financial news, this is the big risk we don't know. They have now penciled in 60 billion in treasuries and 35 billion in mortgage-backed securities.
Right.
And they've said it may start in May, which I think it will.
That's right.
Again, these are all things to make the back end more expensive. That's why the yield curve is no longer inverted. That's why, yes, the Fed is hawkish.
By the way, the yield curve no longer being inverted. Here is the number, 0.19.
Yeah.
Yes, it's no longer inverted technically, but not by much.
Well, it's on a percentage basis, it's up hundreds of percent, right? It was negative 0.08 or something at its worst, something like that. Yeah. So that's a pretty big move for 3 days. So yeah, I think the Fed is absolutely hawkish. And I think the biggest issue I see right now in the market, that's why you and I are talking today, is I believe the bond market gets it. And I think the stock market's saying, I don't believe you. That's what I think is happening.
Well, I think the stock market is going to become a believer on Tuesday.
CPI, that's the read. So yeah, I think the stock market being led by retail investors, I believe the buy the dip crowd is addicted to what has worked, and they don't realize the world changed on Tuesday when, in my opinion, when Brainerd came out with her speech. I'm like, okay, they've lost the last dove. It's over. It is about to get expensive for Wall Street.
So let's talk about that for a second.
Sure.
So this is Friday, Thursday, Wednesday, Tuesday, Monday.
Yep. The world changed Tuesday. Yep.
So Monday the market was going up. Tuesday, it was still okay, but it was coming down.
Yeah. After her talk, it went down.
After Brainerd's talk. Now Brainerd kind of set the stage that, hey, we're getting hawkish. If you hear from me, you got to know it's going to be hawkish.
Yeah, exactly.
But she knew that the minutes were from a month ago.
True.
Not from right now.
Of
right.
Course. Yep.
So here's Wednesday. The market basically did nothing, which is normally what happens when there's a Fed meeting. It will do nothing during the day.
That was Fed minutes, but yes.
That's the minutes, right? Yep. Fed minutes.
Yep.
And then because the minutes came out and they weren't as bad as what Brainerd was painting them to be.
Correct, because they were 30 days earlier, correct? Yep.
That's right. It was 30 days earlier. The market took off on Thursday, and Friday basically did nothing.
Yeah, I agree.
And I think on Monday, it's going to be sort of in the same area, doing nothing.
Nothing burger.
But I think that after the CPI comes out at 8:30 in the morning, we're going to see it break away from this reversion to the mean and head back down here.
Yeah,
towards this three ATR.
I think there's a couple of things that are going to, again, I think the banks, I'm nervous for the banks. I do think I think at least one of the banks is going to talk about loan destruction, loan volume.
Yeah.
And it's going to talk about the consumer not being.
Well, I think all of them are going to need to prepare their shareholders.
And I think that's the day. Tuesday, Wednesday is when the stock market gets religion.
Right.
Okay.
Yeah. So I expect Monday to be kind of nothing happening, not much happening.
Okay.
But Tuesday on till the end of the week, I expect. And by the way, this is consolidation theory. This is a technical trading term.
Mm-hmm.
Consolidation theory says if you have a move and then a consolidation sideways,
mm-hmm.
the next move is normally in the same direction and normally the same distance. All right. Okay. So we're about 4650 up here. We're about 4,500. So it's 150 points. So it puts us down here to 4350 right here at this 2 ATR.
Got it. Okay.
Somewhere in that range. I think it's going to get down here to this 3 ATR actually. So somewhere around 4350 or so.
Yeah. It's going to be fun to watch. The last thing I wanted to ask you in our opening episode together is something you've shared with me a couple of times is you believe we are in a secular bull market.
Right.
You've talked about secular bull markets, I think averaging 15 years or so. We're about
18 to 20.
Okay. 18 to 20. I'm sorry. We're about 10 years or whatnot into this one. I just wanted to ask you, what would have to happen for you to give up that and to say that, you know what, the secular bull is dead. We died early. We're in something else now.
So it would have to break this lower channel down here.
Oh, okay. So right? There is a number. There is a number.
So yeah, there is a number.
Okay.
I'm not sure I can find the chart, but yes, there is a number. 3,700 to 3,800 is about 20% on the S&P.
Okay.
Which defines a bear market.
Yep.
But interestingly, it is not. Let me see if I can. Let me turn this into a longer chart. Let's go back. Let's go back 10 years. Okay. So this secular bull started in 2013.
Okay.
Back here.
I see it. Yep.
All right.
Yep.
And even though we had this COVID crash right here, and it did breach that lower channel
for a
briefly.
Yeah.
But because we were in a secular bull market, it didn't last long.
Okay.
Which is also what will happen when we get to the next recession, which is probably coming up here soon.
Yep.
We probably will have a recession, but I don't think it's going to be a long one.
Okay.
So if we just take this and draw a line across these lows right there.
Okay. So
that's
3,
the channel. So 3,000, it would have to get below 3,000 for the secular bull to be broken.
Okay. All right. So and we're at like 4,600,
4,500. Yeah.
All right. So that's a 33% fall. Easy math.
Yeah.
Okay. All right. I just wanted to know. I was just, just because they average 20 years doesn't mean everyone is 20 years. So I was just curious.
Well, actually, everyone is 20 years. This goes back 100. This goes back 100 years. So 1950 to 1970. Well, actually 1969, roughly.
Okay.
So 18 or 19 years. And then 82, 81 right here.
Yeah, I see it.
81 to 2001.
Okay.
It's 20 years. So we're in the third secular bull market in a 100-year period.
Okay.
So everyone does last 18 to 20 years.
Okay. All right. I just wanted to ask because I think
no, it's a really good question.
Yeah.
And this I think highlights how far we've gone.
Yeah, it does.
I mean, we're so overbought right now.
Yeah.
But it also shows how far we have to go for the secular bull market to break.
Got it. Perfect. Very, very cool. Dan, do me a favor, bring up your newsletter again, because it's something I read every weekend and people should get. It is absolutely free and has some hilarious cartoons.
Yeah, here's 2 of them.
There we go. Breakpointtrading@gmail.com.
Yep, there was some good stuff in this one, including this chart right here.
Yeah, so I did a economic review 2022 and 2023. I pegged the Fed at 2.75 by the end of the year. Let's see.
End of this year?
Yeah, end of 22. Yeah.
Well, the market is showing 33%. 33% of that happened.
I'm usually ahead of them. That's okay.
I don't think it's going to happen. I'll take the under on that.
I like it.
I think the Fed is going to be aggressive until they can see that that trend line.
Where do you think it stops? 2%?
No, I think it'll be higher than that.
Okay.
I think it probably stops at 2.5.
All right. So we're one raise different.
Yeah, 2.5 the most. But I think they're going to do 2 half-point raises.
No question. They have to.
So that's May and June.
Yep.
I think July they might have the first data point that we had peak inflation.
Yep.
And then they'll back off a quarter point.
Yeah.
I think
hold on. When you say back off a quarter point, you mean cut?
Yeah. No.
Okay.
I mean a half, and a quarter.
Yeah, I agree. Half, quarter. Yes.
Right. And then I think in September at that meeting, they will have a clear trend line.
Okay.
That we've had peak inflation, and they will say we're going to pause.
Okay.
Our strategy is still on the table.
Yeah.
We still are planning to raise, but we are going to pause.
Yeah. So
I think that pause lasts till the end of the year.
Okay. So that's where I'm different. Well, hold on. So half, quarter, and we just so you're only calling for 1.5 points.
Half, quarter. Yeah.
So you're not at 2.5.
1.5. Yeah.
You're at 1.5.
Actually, I think it might be 2. And they might do it. They might do another quarter in September, but then they're going to, but they will explicitly state that this is the last one. We're going to pause till the end of the year.
Okay.
So maybe 2.
Okay. I like it.
And here's what's going to happen. And I've been saying this for a while. In fact, in my newsletter this week, let me put this up here. In my newsletter, I put in, this is Stock Traders Almanac.
Mm-hmm.
They've been around for years and years, and they basically look at historical trends.
Mm-hmm.
And they have some strategies based on historical trends in the market.
Yep.
They're saying right now, sell the S&P and sell the Dow.
Oh, wow.
Get out of the market right here.
Okay.
They just posted that. All right. But if you look down here at the very last sentence, I've been saying this all along, but eventually the next great buying opportunity will come along, most likely in late Q3 or early Q4. When the Dow says that when the Fed says that they're going to pause,
yes,
the market is going to explode.
It's going to rip. Yep.
Explode. And anybody that's in it right now should be conservative, should be careful, should be nimble, should be, making sure their gunpowder is dry, because sometime in September, there is going to be a great buying opportunity into the end of the year. Now, I think the recession is going to come the beginning of the next year.
Yeah.
But the end of this year the market's going to explode. That's what I think.
Very cool. This is a lot of fun, folks. Again, Dan is helping me understand the stock market, which, if you know my story, is something that taught me some nasty lessons with $150,000 loss. So thank you for coming along as I learned some new skills.
Yeah. And by the way, in the next session, we've been using the analogy of learning French.
Yep.
With looking at technical analysis and charts. So we're going to do a French exercise in the next session. We're going to look at a bunch of charts, and you can tell me whether you be a buyer or a seller.
I like it. And again, play along with me, folks. Get some paper out, and play along. So this should be fun. Thanks, buddy.